Welcome to Talk Tickers. So, when a company's stock rockets up more than 6% right after dropping an earnings report, you know you have to pay attention. Today, we're digging into HEICO's fourth quarter results to see exactly what sent Wall Street on such a buying spree.
And I mean, look at that. The market's verdict was crystal clear. After the numbers came out on December 19th, the stock just absolutely took off, closing up over 6% on some pretty massive volume. No two ways about it.
So to really understand what's behind that jump, we're going to walk through their record-setting quarter, break down exactly how they beat the street's expectations, and then get into the secret sauce, what management calls their growth flywheel. We'll also touch on what analysts are focused on and wrap it all up with our take on what's next.
Let's dive right in. The tone from management was just overwhelmingly positive, and honestly, they had every reason to be. They posted record results pretty much everywhere you looked, and yeah, the market was more than happy to reward that kind of bullish performance.
Okay, so let's get into the nitty-gritty. It's time to deconstruct the beat and look at the actual numbers that fueled this big rally.
First up, the bottom line, earnings per share. HEICO delivered a GAAP EPS of $1.33. Now, what's really key here is that this wasn't just a solid 9% beat over expectations. No. This was a massive 34% increase year over year. That is the kind of explosive growth that really makes Wall Street sit up and take notice.
And it wasn't just on the earnings side. The top line was just as strong. They pulled in over $1.2 billion in revenue, which crushed the consensus estimate by almost $40 million. That works out to 19% growth from last year, which management said was driven by strength, and I quote, across the board.
But the story here goes way deeper than just the headline numbers. When you look under the hood, the core business is absolutely firing on all cylinders. I mean, their operating margin expanded by 150 basis points to over 23%. Their operating cash flow just exploded, up 44%. And on top of all that, they're strengthening their balance sheet, bringing that net debt to EBITDA ratio way down to just 1.6. It's a really clean story.
So that's the what. We see the great results. But the real multi-billion-dollar question for any investor is the why. How in the world does HEICO pull this off quarter after quarter? Well, it all comes down to a really simple but incredibly powerful growth flywheel.
And here it is. This is basically their three-step algorithm for success. It's the engine behind everything we just saw. It all starts with really strong organic demand for their aftermarket parts. Then, they take the powerful cash flow from that business and use it to fund a very disciplined M&A strategy, where they go out and buy these great businesses that just bolt right onto their existing model. It just keeps feeding itself.
And believe me, that M&A engine is just getting warmed up. On the earnings call, management said their pipeline is, and I'm quoting them directly here, very strong, busier, and busier. And remember that low debt ratio? That means they have a ton of firepower to go out and make more deals happen. And they are so smart about who they buy. Just look at these recent acquisitions. With EthosEnergy, they're jumping into the industrial gas turbine parts market, which is a fantastic way to play the insane power demand coming from the whole AI revolution. Then with Axillon, they're digging their moat even deeper in the specialized defense sector. And here's the kicker. Management expects both of these deals to start adding to earnings within the first year.
Okay, so the numbers look great, the strategy is working beautifully, but what are the big questions? What's on the minds of the sharpest analysts out there? Well, the Q&A session from the call gives us some really good clues.
The questions really boiled down to a few key themes. Can this M&A machine keep humming? How much more value can they squeeze out of that big Wencor acquisition? And, the big one, as the company gets bigger, is that 15 to 20% long-term growth target still actually realistic? They also dug into the outlook for defense and for new engine parts. That's the PMA business, which is really HEICO's bread and butter. To their credit, management was confident and constructive on all fronts.
And it looks like Wall Street is buying that story. The sentiment is broadly bullish. You've got analysts from places like Citigroup initiating coverage with a buy rating and a $367 price target, and most of the other targets are clustering right around that same mid-360s level.
All right, let's put it all together. It's time for our take on what to expect for the next call, and we'll even throw in what we're calling our outrageous but plausible trade idea.
So really, it all boils down to this one big question for the stock. After putting up a monster 34% earnings growth this quarter, can HEICO's long-term growth algorithm of 15 to 20% a year actually continue? Can they keep defying the law of large numbers?
Our answer is a pretty confident yes. We think this team is going to continue to execute and beat what the market expects, so our rating on the stock is outperform.
And that leads us to the trade idea. We're pitching a long position in HEICO,
hedged with a short position in ITA. That's the broad aerospace and defense ETF. The thesis here is really simple. HEICO's unique M&A strategy and its focus on these super profitable niches gives it an edge, a source of alpha that the broader, more generic sector ETF just can't match. And this isn't just a theory. You can see it's already outperformed the sector over the last year, and we think that performance gap is only going to get wider.
So there you have it, our debrief of HEICO's very impressive quarter. And as always, please remember, this is not financial advice. Be sure to consult with a professional before you make any investment decisions.